All right, the closing bell rang about 15 minutes ago. We have the institutional analysis for Monday, December 29th, and we are deep in the final trading days of 2025.
Yeah, this is where it gets tricky. The mission today is to cut through all that noise, the holiday-thinned liquidity, the window dressing. We need to see what the real money was actually doing.
Okay, let's unpack this. Starting as always with the scoreboard. It was a soft sea of red today.
It was. Let's just lay out the data. The S&P 500, it shed 0.3%.
Okay.
The Nasdaq, which has been the big winner this year, dropped 0.6%.
Bit heavier there.
And the Dow lost 0.4%.
Yep.
So no catastrophe, but a clear retreat across the board.
A retreat, but you have to put it in context. I mean, S&P up 18% on the year, Nasdaq an incredible 22%. So the narrative today, from what I'm seeing in the sources, was just a choppy mess.
That's the perfect description. It was driven by one thing: low-volume profit-taking.
Simple as that.
It's a classic year-end phenomenon. When you've got performance that strong and, well, no fresh catalysts.
Especially in tech.
Exactly, especially in the AI space. You just don't have enough institutional buyers willing to chase those highs. The sources are specifically citing valuation fatigue around the big winners.
And when you say valuation fatigue, you're talking directly about the mega caps, right?
Yeah.
The Nvidias and Teslas of the world, which dragged the tape down.
Precisely. Nvidia is down, what, 1.7%?
1.7%, Tesla 1.5%.
Right, 1.5%. They became the easiest place for large funds to just, lock in those massive gains for their 2025 books.
But the context here is key. This selling it's being categorized as a temporary speed bump.
We have to stress that, yeah. Because the volume was so light, which we'll get to, this isn't a fundamental trend reversal. If this happened on full liquidity, we would be having a very different and much more worried conversation.
Understood. But okay, if the high flyers were sold, that cash had to go somewhere. Let's pivot to the sectors, because there's a pretty distinct rotation today.
A massive divergence, actually.
Yeah.
The leaderboard shows money flowing into areas that either offer safety or a very specific non-tech catalyst.
And the clear winner of the day was energy, up a solid 1.0%.
Yep, and this wasn't just general market sentiment. This was a textbook geopolitical play.
Right.
Rising crude prices, specifically tied to new tensions. The sources mentioned a potential U.S. blockade on Venezuelan tankers.
Yeah.
That fueled the whole move. ExxonMobil, XOM, was specifically called out as a key beneficiary.
So people are chasing definite news, not broad themes.
That's the environment we're in.
Okay, so conversely, where was the pain trade?
That was concentrated in materials, sinking 1.1%. And this leads us to what was probably the most violent move of the entire day.
The key reversals.
Key reversals in hard assets, especially silver.
Here's where it gets really interesting, because the S&P looks quiet compared to the chaos in silver. The metal surged to, what, an overnight high of $84 an ounce?
$84.
Yeah.
And then the floor completely fell out.
Just a total collapse.
The whole thing crashed. Lost between 11 and 13% from that high, dropping right back into the low 70s. That is a forced flush.
Yeah.
You're talking about evaporating weeks of gains in just a few hours.
You have to ask why, right? Why that severe? It sounds like more than just profit taking.
Oh, it was. The sources identify the trigger immediately. CME margin hikes.
Ah, okay, the mechanics.
It's all mechanics.
Yeah.
If you're a leverage player and the exchange says you need more collateral, you are forced to sell. Period. You have to meet that requirement. And that's how market mechanics can just crush that, social media hype that drove it to 84 in the first place.
So the leverage money got flushed out. We also saw some of that technical weakness in the broader S&P, didn't we? It opened at a new record.
It did. A fresh intraday record of 6,945.77. But then it closed near the session lows.
A classic outside down day setup.
It's the hallmark of one. It shows rejection at a key psychological level. When you combine that with the Mag 7 names failing, it just screams that institutional desks were using the open to sell, not to buy. They were distributing.
Which brings us perfectly to the core question. Market internals. Did the real money actually buy this dip, or was this truly just a low conviction drift?
It was overwhelmingly low conviction.
Yeah.
And the data here is critical. Total volume clocked in at just 10.22 billion shares today.
Okay, and for perspective.
To put that in perspective for you, our 30-day average is closer to 15.98 billion.
Wow.
We traded on barely 2/3 of the typical volume.
So the takeaway here is simple. Don't read too much into the red tape.
Exactly. Don't confuse drifting prices with confirmed signals. These prices are easily pushed around on light orders, which makes the tape really susceptible to a quick reversal once everyone is back in January.
Now, you mentioned institutions were fading the rally. What were they looking at that made them so cautious?
They were looking at a massive macro signal,
Hmm.
the Shiller CAPE ratio,
Right.
the cyclically adjusted PE ratio. That metric crossed the 40 level recently. For you, the listener, think of this like a smoke detector going off. A CAPE ratio above 40 is extremely rare. We've only really seen it during bubble environments like the late 90s.
So if the smart capital sees a valuation metric that rare, what's their internal response?
It triggers strategic preservation protocols. It basically tells portfolio managers, look, you've won the year. Don't risk your 22% gains chasing S&P 7,000 in the last week of December.
So they're locking it in, prioritizing capital safety over momentum.
100%. And that mentality speaks directly to the market breadth being so fragile.
The classic hollow rally.
It is a fragile structure. We look at the advanced decline ratio on the NYSE. It closed at 0.8 to 1. So for every 8 stocks rising, 10 were falling.
Not a broad-based rally at all.
No, it's a concentrated liquidity hideout. And this is where the infamous practice of window dressing comes into play.
Explain that for us.
It's like preparing a house for a showing. You clean up the front yard, the living room. Those are your generals, the mega cap tech stocks that everyone owns. You want them to look good.
Yeah.
But you leave the mess in the attic. Those are your soldiers, the small and mid caps that are being quietly sold off for tax loss harvesting. That kind of top-heavy structure is just extremely brittle.
Now let's talk about the VIX, because it's telling a deceptively calm story, drifting down toward 12.50.
Yeah, that drop is classic year-end IV crush, implied volatility crush.
Now.
With no major events left, the time value of options just decays rapidly, so protection gets cheaper.
But low VIX does not mean low risk.
No, in fact, it can increase it. What's fascinating is that the low VIX creates what analysts call a gamma vacuum.
A vacuum.
Basically, when dealers have fewer hedges on, they aren't positioned to absorb a shock. So if a surprise headline hits, the move will be violent because there's no buffer. The market isn't positioned to dampen it.
That underlying fragility. It leads us to the biggest red flag in the notes today, the bearish divergence.
This is the most crucial takeaway for you to remember. The S&P 500 is near all-time highs, but the percentage of stocks above their 50-day moving average is falling.
So the index price is high, but fewer and fewer stocks are actually participating in holding it up.
Exactly. The number of healthy stocks is shrinking. Historically, this type of divergence, high prices, weakening breadth, it perceives a significant correction in the next quarter. It's a warning that this window dressing is masking fragility that's going to get exposed in January.
Okay, let's pivot. Given all this, what is the absolute line in the sand for tomorrow's open? What's the high conviction level?
The focus has to be entirely on the gamma wall at 6,900 on the S&P 500. It is a massive magnet for price right now.
And what's the key support level we have to watch below that?
We must hold 6,880. That is the critical level. Above 6,900, dealers are long gamma. Think of it like a market speed bump. They sell into strength, buy into weakness. It keeps things range-bound.
So they act as a natural break.
A natural break. But if we slide below 6,880, they flip to short gamma.
Which is the opposite.
It's like hitting a steep hill with no brakes. Dealers have to accelerate the move down by selling into weakness. That scenario takes us very quickly towards 6,850. So the advice is scalp the range, don't swing for the fences unless 6,910 breaks clean.
That's crystal clear. Now, let's look at a couple of specific setups for a day 2 continuation. First, Digital Bridge, DBRG.
DBRG was all about the SoftBank acquisition news, a $4 billion deal that triggered a huge 9.7% surge today.
M&A news has sticky momentum in this tape.
It really does.
Yeah.
So the setup is to look for a high-tight flag on the 15-minute chart tomorrow. The key level to watch is today's midpoint, that $15.20 level. If it holds, the day 2 target is a test of $17.50.
High reward, high risk. And the warning here is critical.
Absolutely. Do not chase if it gaps up more than 3% at the open. The risk of a rug pull is extremely high in these low-volume conditions.
Okay, quickly, a secondary play.
Let's connect back to energy, ExxonMobil XOM. It's a solid continuation play. Energy was the clear winner, driven by geopolitics. So this setup is a long continuation as long as Brent crude holds that $61 level.
So wrapping this all up, what does it mean? The market is top-heavy. The selling was mechanical, not fundamental. The mandate is clear. Stay disciplined, keep size small.
That's right. The probability of a follow-through red day 2 after this kind of day is actually pretty low, historically, maybe 30–25%. So that suggests mean reversion is more likely tomorrow. But, and this is a big but, the underlying bearish divergence confirms the fragility is absolutely real.
Which raises the big question for you, the listener, heading into the new year. The ultimate catalyst is the upcoming Fed minutes. Will the 2026 rate pivot be confirmed, or was today's profit-taking just a prelude to a significant repositioning once the big desks are back in January? That's the key question for the opening bell.
Don't let a Santa Rally exit ruin your 2025 P&L in the final 72 hours. Strategy out.